So good afternoon, everyone. Today we're going to continue our discussion on portfolio, creating portfolio using Excel and using our historical data, and then also creating the efficient frontier. So last time, what we did was to learn how to download data from Yahoo Finance, right? You recall that class?
Yes, sir.
Okay, so it's easy for us to download data from Yahoo Finance. But actually, if you're connected to the internet and you're using Excel, you can also download data directly. You don't have to go to Yahoo Finance. You don't have to visit Yahoo Finance, the website. So let me illustrate to you. So let's start date. Can you see the screen, class?
Yes, sir.
Yes, sir.
Okay. Start date and date. Yeah, let's identify a start date. Okay, maybe let's choose 20. Okay, 1/1/2016, January 1, 2016, and then ending up to 12/31/2022. Okay, so our start date is 1/1/2016. Our end date is December 31, 2022. Okay, so let's give this a name. I'll highlight this. Okay, Control Alt, Control F3. Okay, mali. Okay, I think I should delete all of this. Delete. Okay, so that there will be no conflict. Control Shift F3. Okay, again, Control F3. Let me delete first the names here. Okay, this one delete. This one delete. Okay, no more names here. All right, so let's give this a name. Control F3. Oops. Control Shift F3. Okay, and the name is on the left column. So I'll remove this. Okay, so this one now has a name, start date, and this one has an end date. Okay, let's identify some stocks that we're going to download. Okay, could you kindly help me? Let's have maybe Microsoft. How many stocks? Let's Microsoft, and then Meta, Facebook, Google. Let's mga tech stocks to, no? Amazon, and then let's also include JP Morgan, okay, and then Goldman Sachs. Let's also include, let's see, McDonald's. I mean, 1, 2, 3, 4, 5, 6, 7. Intel, 8. Okay, let's just make it 8 stocks. Okay, so actually we can download stock prices from Yahoo Finance without going to Yahoo. Okay, this is I don't know when this started. Is it 2016? I think Excel 2016, or I'm not sure. Hopefully this works in your Excel. I'm not sure if this is just for 365. Okay, so we can use this one is equal to stock. Okay, there's a function called stock history. Can you kindly see if you have that, please?
Yes, sir.
Okay, good. How about the others?
None po for me, sir.
Wala.
Yes.
Iba? I have it. Okay, Kim, thank you. None for me. Okay. Kay Carlos, wala rin. So, sino pa? Kay James, meron. Kay Gerald, meron. So, sino yung wala kanina?
Ako po, sir. Maradag po.
Anong version ng ng Excel ang ginagamit mo?
Let me check, sir.
Tapos Carlos, wala rin sa'yo. Sino gumagamit ng Mac? Gerald, Mac ka, di ba?
Ako po, sir. Mac din po.
Mac,
I'm Windows, sir.
sino to? Si? Of the free MS Office subscription given. Bakit hindi pa ba kayo Rhea, hindi ka pa nagpapa-load ng Office 365 sa school?
Version 16 pa po yung sa akin. 16.16.27.
Magpaano ka na? Free naman yun sa school eh.
Saan po, sir?
Sa ITS. Punta ka sa ITS.
Okay po, sir.
Pwede. Free yung Office 365.
Okay
Tama
po,
si Luis, tama. Ikaw, si Carlos.
Sir, I'll try it po ulit. Wait. I'll try to refresh.
Sige, if it does not run now, anyway, naka-record to. Tapos magpa-install kayo ng Office 365.
Sir, I have it po. It's, yeah. I think I
meron.
spelled it wrong, yeah.
Okay, good. So si Rhea na lang, Okay, the rest are okay. So Rhea, anyway, naka-record to I'm sorry, hindi masusundan mo na to, So,
Yes po, sir. I'll
sorry
try.
about that. Sige.
Update po.
Okay, sige. Good. All right. So this is very convenient kasi class yung stock history and stock history. So start date, and start here, comma, end date, this one, diba? Okay. Okay, comma, and then leave muna natin ng blank, no? Leave lang natin na ganyan. And then if you control enter, okay, nag-value siya. Bakit? Ulitin natin. Wait. Let's write the formula here kasi susulat siya dito ng let stock history. Okay. Sorry, ang tagal ko na hindi nagamit to, no? Start date, end date, okay. Default daily, close. Pwede nandito yan. Yan na muna, no? Okay, bakit ginamit ko pa lang kanina to. Okay, so sorry. Again. Stock history. Start date. End date. Ay, mali. Sorry. Yung unang parameter dito yung stock. Dapat ito. Sorry, class. Okay? So we first have to link it to the stock that we want. Okay na to. So is equal to stock history. All right. Stock is Microsoft. Start date, end date. Close na muna natin. Control enter. Okay. All right. So dapat Control Z. Okay. Dapat dito ako na gano'n. I should have control. I'll just move this first here. Okay. I should have written my formula here. Dapat dito ko sinulat yung formula. Writing ko last time para tama. Okay. We write here the formula is equal to stock history, and then Microsoft, comma, start date, comma, end date. Okay. Control enter. All right. Diba? Na-download siya. So this is daily prices from January 4, 2016. up to December 30, 2020. Okay, you got it, class? Kindly chat, please, if you got it. Alam ko pwede rin online eh. Pwede rin i-ano online. You can use your De La Salle ID, De La Salle email, and then you can, hindi ko lang alam, would somebody know, class? Rhea, kindly share your question to everyone. Would somebody know how to install yung Office 365? Rhea, paki-share yung answer, yung question mo to everyone.
Hello, sir.
Yes?
It says blocked for me.
Sorry?
I'm getting an error.
Error saan?
I can't get it currently.
Sandali ah. Okay, paki-share nga yung screen.
So it's here. I
Start
can't.
start ka muna sa Start ka muna sa A6, yung pagsulat ng formula. Delete mo na yan. Delete mo muna yan, Gerard. Okay. Doon ka magsimula sa A6. A6. Hindi. Go to A6. Column A, row 6. Yan. Is equal to. Close mo. Control enter mo nga. Bakit blocked?
Sir, I think I'm it says here that I think I'm not have a license required or something, not sure.
How to correct in block. Nagpa-install ka ba ng 365 sa school? Ano yung version ng Excel mo?
Not sure.
Okay.
Uh,
Pero hindi, I'm not sure. You haven't installed Office 365 from the school. Kasi free naman yun eh. You would know if you did that. Pero pag hindi, ibig sabihin, pag not sure, ibig sabihin hindi ka nagpaano. Ganun din kay Rhea, siguro magpaano ka. Kasi baka hindi siya nag-work kung ano eh. Bakit kaya naka-block?
yeah, I think that must be the case, sir.
Pero yung sa akin, ginamit ko rin po yung 365 subscription ng school, pero block yung akin.
Block din. Okay. So siguro ay kay Kim ganun din, no? Okay, siguro na lang. Doon ka ba nagpa-install, Kim, sa sa ITS ka nagpa-install?
Sir, me, I did it by myself before, pero naka 365 Office 365 subscription na po.
So sino to? Who's talking?
Sir, si Kim po.
Kim. So is it working yung stock history na formula?
Sir, no po. Naka-block din po yung nakalagay.
Sige, i-share mo nga yung screen mo, tingnan natin. James, yung yung Excel mo pina-install, yung Office mo pina-install mo sa sa school?
Sir, okay naman po sa akin, sir. Gumagana naman po.
Okay, so sino pa? About in your case, Jillian.
Sir, yung sa akin, ako lang din po yung nag-sign up. I remember para may pinost sila ng instructions dati, tapos
Mm-mm.
sinunod ko lang.
Yeah, online lang, no?
Yes, sir.
Tapos gumana naman sa'yo yung stock history ngayon.
No, sir, naka-block rin po siya.
Naka-block din. Luis, sa'yo?
I installed it, sir. Yeah, may instructions.
Sorry?
May instructions po dati, tapos sinunod ko.
Oo. Eh, ngayon, gumana ba yung stock history?
Gumana po. Siguro try sign in ulit if ever.
Sige nga, do that class. Try nyo nga ba't kaya ganun, no? I'm not sure kung bakit nabablock. So maybe it has something to do with the access. James, sa'yo naka-block din?
Hindi po, sir.
Gumana.
naman po.
Kay James gumana, kay Luis gumana. Sino, si Rod, andito ba si Rod? Okay. Anyway, so let me just illustrate to you kung paano i-download via stock history. And if it doesn't, then we'll just use the prices that we downloaded before. Okay, but let me continue first. So I was able to download here Microsoft. And then if let's say I'm going to download, if I'm going to download also Meta, so I go here, it's equal to stock history. Okay, my stock is Meta. I'm going to copy this to the right, comma, start date. That's why I gave this a name, because I'm going to copy this to the right, comma, end date, okay, and then comma. Now, it's different now because here the default is daily, so I will not mind that. Another comma, no header, okay, 0, no header, comma, and then 1. Okay, now there are the data that's given here are only 5. Date, closing, date, close, open, high, low, volume. There's no adjusted price. So would have been good if there was adjusted price, but let's just use the closing date. I'm going to type 1 here, there. Okay, and then Control Enter. It will load now. Okay, it will not include the date since I defaulted on 0, which means 1, which means Excel will just give us the closing price, and then I copy this to the right. Okay. Okay. Okay, maybe I'll save this now and then I'll share this with you so that we control. Okay, control 1. Okay, and delete. Can't access my. Number. Okay, I remove the $sign. Highlighted red. What do you mean by that, Alice?
Actually, sir, it worked when I logged in again.
Nag-work na sa'yo.
Yeah.
Okay, good. Try nyo nga the others, please. Log in again. Log in saan? Saan ka nag-log in?
Sir, yung sa Microsoft, like,
Okay.
yeah, I just had to refresh my account because I also got it during the pandemic. So maybe like I just had to log in again.
Sige. The others, could you kindly try?
It's working now, sir. Thank
Are
you.
working now. Good, good. All right. So let's wait for the others. Anong ginawa mo, Gerard? Anong ginawa mo?
I logged in
Log in then.
my
Okay.
school account.
Sige. Sige. Also do the same, Rhea and sino pa ba? Julian. Okay, we'll wait for you. Come. Ladies, we'll wait for you.
I-work na rin po.
Okay, good. Who's not here? Si Rod, andito ba? Rod? Ba't bigla nawala si Rod? Hello, Rod? Mahirap yung pagpapa-attendance lang ha, tapos wala din. So, James andito, Jillian is here, Luis is here, Carlos, Rhea is here, Kim is here. Okay. So, dalawang absent. Tell Rod, I marked him absent kasi nawala siya eh. Okay. All right. So, okay na, class? Do you have now Microsoft? Do you want me to repeat the process?
Repeat po.
Repeat the process. Sige. Okay, let me delete everything. Okay. So first, we write a start date and an end date, and then we gave it a name, no? Because we're going to copy this to the right later. Okay. So we're going to put here first. We will start here. Well, first we identify the stocks that we want downloaded. Okay, the advantage of this one is that you don't have to go to Yahoo Finance because you experienced before that it was quite a what's the term for that? Time consuming. Okay, it was time consuming to go to Yahoo Finance, find the ticker symbol of the stock, and then download it. Okay, here it's directly downloaded to Excel. So we're going to use here the function stock history. The stock is this one. So we're putting it here because for this one, we're going to ask Excel to write the date also. So stock, comma, start date is this one, comma, end date is this one. Okay, and then I close this, Control Enter. Okay, and then it gives us both the date and the closing price. Okay, so these are the data stocks for Microsoft. Okay, and then let's go to Meta. I'm going to start here. Okay, then is equal to, again, stock history. My stock is this one, Meta, comma, start date is the same, which is okay because we're going to copy this to the right, no need to fix this, and date, and then this is where the difference lies. I type comma, so the default is 0 daily, so we can put 0 or just ignore because we want daily prices. Another comma. So, oops, what happened? Why the M7? Comma, then no header, okay? We don't want any header, comma, and then here, date, close. What we want is a close. So I have here 3 commas and then 1, right? Close this, and then Control Enter, and then it's now downloading. There you go. Very fast, class. Very fast. And then we can now copy this formula to the right. There. Okay. Right, class? So how do you think of this functionality of Excel? What do you think about this functionality of Excel? Hello?
Maganda sir, pero sayang lang walang adjusted.
Oo nga eh, sayang. Walang adjusted eh. But anyway, for our purposes, let's just use the closing prices. Hindi ko alam kung bakit hindi sinama yung adjusted. So much easier. Yes, that's correct. A lot faster. Don't have to go to Yahoo itself. So apparently, Excel and Yahoo joined hands. So Microsoft was able to get the API for Yahoo Finance. So you can, maybe we can, I don't know if we can, okay. What's a, I'm not sure about the ticker symbol of Adidas. Is it Adi.Deutsche? Okay, let me see. Okay, it does not. Maybe, what's a ticker symbol? Can anyone please check the ticker symbol of Adidas? Yes, it's ADS. Okay, let's see if we can, this is listed in the German Stock Exchange. It's listed in the German Stock Exchange, but you can get it from Yahoo also. Let's copy this. Just want to see if you're able to extract. Ayaw. So anyway, so maybe we can explore if we can also get from Yahoo Finance stocks that are listed in the Japanese, the Tokyo Stock Exchange, or German, the Frankfurt Stock Exchange, etc. I haven't tried that. Okay, anyway. All right, so let's now move on. And when we do portfolio optimization, portfolio analysis, we don't deal with the prices. What we're interested in are the returns. Okay, so let's copy this, Control C, and let's move it here, Control B. I'm copying it here because to get the returns for okay. Should be here. Okay. I'm going to put the names here, and then we're going to get the returns. So there are two types of returns. You can have the simple returns, which is just equal to the price at time t divided by price at time t minus 1 minus 1. So that's your discrete return, or so that's called your discrete or simple returns. The other one is your log or continuous. Okay, usually class of finance, what we use is continuous returns. And there are many reasons why it's being used. And one is I'm going to show you in a while. So log or continuous returns is obtained by getting, in Excel, it's ln. That's a natural logarithm. In R, it's log. So that's the ln of the price at time t divided by the price at time t minus 1. Okay, Control Enter. All right, so that's the return, daily return. Then we can copy this to the right. And down. There. Okay, so just to distinguish that from, let me put some shade, a bit of shade here. Okay, so just to distinguish it from the prices. Okay. All right. Kindly chat, please, if you were able to follow. We're working on a relatively high amount of data. Let's, in order for us to facilitate our computation, okay, or let me do that later na lang. Let me do that later. Okay, so I want to ask you something, class. I mentioned a while ago that in finance, the use of continuous or log returns is preferred. Okay, what could be the reason for that? If you wanted to get the returns from, let's say the beginning of the period that we're looking at from January 4, 2016, compared to December 31, 2022, what was the log returns, class? By how much did Microsoft grow from January 4, 2016 until December 30, 2022? How much was its continuous return, its log return? So you just follow the formula. The formula will be, yes, anyone? Would like to know by how much did the price of Microsoft grow between January 4, 2016 and December 30, sa last day, December 30, 2022.
Sir, you get the last period and divide it by the first period. Tapos log.
Okay, so what did you get?
Around 147.6%.
147%. Okay, let's validate that. So it's equal to the ln, natural logarithm, of the last day divided by the first day. You know? And you get, yeah, that's around 1.47 times, 1.476 times. So the stock price of Microsoft grew by about 1.5 times. As of December 30, 2022, the price was 239. It started 54.80 at the start of 2016. Okay? All right. Now, so that's around 147%, or it grew by 1.47. Now, what happens, class, if you take a look at discontinuous returns of Microsoft? Okay, let's try to see what's the cumulative returns. For Microsoft, class, from the beginning up to the end. What is the cumulative returns?
For the log returns po ba?
Hindi. Sa Microsoft, okay, you base it on the returns. May returns sa tayo dito. If you cumulate this from the beginning up to the end, how much was the cumulative returns?
It's the same, sir.
Yeah, it's the same, no? So that's one of the reasons why the log returns or compounded returns is preferred over the simple returns. You cannot do that with the simple returns. Okay, so if you want to determine what's the period return growth rate from a particular date to another particular date, okay, you just get the ratio, the log ratio from the latest to the earliest, between the latest and the earliest. Okay, and then you'll get the same as cumulating the returns from the earliest to the latest or latest to the earliest. Anyway, you're just adding. So as I was pointing out, if you add this, it's equal to sum. If you cumulate, okay, wait, it's too long. It's equal to, anyway, here, alt equal to, oops, not there. Alt equal to, okay, there. Control or enter. Oops, mali. I added where ba inadd ko? Okay, there. See, 1.47, no? Pareho siya. No? 7620, 762. Okay? So, yung compounded returns class, that will give us the summation of the cumulative returns for the period under consideration. That's why there's an advantage of using your log returns. It's easier to deal with it or to manipulate it or to hindi ko nakikita ang screen. Medyo yung araw. No? Okay, so we learned how to compute for the returns. We learned how to compute for the difference between the discrete returns or simple returns is that you're just getting the average, the growth rate from one point to another point. So for the simple returns, it's just this amount divided by this minus 1. Okay. So next, we will need to, let's copy this again, Control C. We will compute for the excess returns, but before we compute for that, we will have first to, okay, we will need to compute some amounts like let's compute for the average returns, okay, the standard deviation. Okay, let's compute for those things. So first, let's compute for the expected returns. Okay, let's see. Let's write here expected. Okay, and that one is usually denoted by E sub R. Okay, we're using here finance terminologies. Why did it registered? Okay, so we will be computing for this one. Aside from the expected returns, we will be needing the count. Okay, and also we will be needing the variance. the variance, which we will denote as, let's insert here, insert tayo ng sigma dito, insert symbols, and then I'm using Greek and optic, andito si sigma, okay, and then I'm going to put here 2, control 1, then superscript, there. So this is our variance, and of course, standard deviation, we can just copy this. So just be the standard deviation, okay? And then let's also compute for another metric called the Sharpe ratio, which is just your expected return divided by your, nag-register din naman siya, divided by your, insert again, symbol, your sigma, okay, insert. Okay, ba't naka-3 to? Okay? And let's copy this. Okay, I'll give you a few seconds, class, to work out this table. Let's give this a clean border. All right. So the expected returns will just simply be the average of our returns, of our continuous returns. So that's from Microsoft. Control Shift down arrow, Control backspace. We go back here. Control Enter. Then we can just copy it to the right. There. Maybe we can make this as %. Okay. But I'll give you a few seconds to work on that, class. If you're ready, kindly chat yes. So that's simply the average of your returns. Kindly chat, please, if you're done. Or you have any questions? This is just the average of the returns. Average log returns for Microsoft, for Facebook, for Google, etc. Okay, thank you, Luis. Let's wait for the others. Experiment lang ako, ah. Feedback, please, class. I'm waiting for you to finish, to be able to compute for the expected returns.
Then, sir.
Okay. Yes, questions? Okay, Carlos, Tim, James, okay na. Luis, also for non-US like Adidas. Pwede rin, no? Pwede rin, Luis. Okay, may comment dito si Luis. Luis, share mo nga yung comment mo sa class.
Wala. Kasi medyo weird si Excel po when it comes to non-US stocks. Pero,
Hindi. Akala ko okay siya. Hindi ko pa na-experiment din eh. Kasi may
Okay.
Yahoo Japan, and then some German stocks are listed, of course, in the stock exchange. Yung sinabi ko na Adidas, that's part of the, ano siya, yung index siya ni Deutschland. Eh. Okay, I think most of you have gotten it. All right, so for N, we just count the number of observations is equal to count. Okay, count lang natin kung ilan siya. Ilan yung returns. Okay, 1761 returns. Actually, don't need the others kasi pare-pareho ng 1761 yun. And then, you need to compute for the variance .s. This is just sample kasi hindi naman to lahat ng returns ng mga stocks natin. So let's get the variance of Microsoft first. Control Shift down arrow, Control backspace, close, Control enter. There. That's the variance. Okay. And then if I get the standard deviation, it will just be the square root. It's the square root of your variance. And our Sharpe ratio will be equal to our returns divided by our unit risk. Okay, once again, when you're done, class, kindly chat.
Sir. Sir.
Nakamute pala ako, sorry. Yes, it's a question? Sino yung may tanong? James.
Sir, patingin po ng formula po dun sa N po. Tsaka
N.
sa variance.
N is just the count. Binilang lang natin. And then sa variance, var.s.
Thank you, sir.
Okay. Any other questions, class?
Sir, can I see the formula for the Sharpe ratio?
Sharpe ratio, okay. It's just the ratio of your expected returns and risk.
Oh, okay, sir. Thank you.
Okay. All right. Okay, if you take a look at the performance of the individual assets, it seems that Microsoft is 0.08. Just doing a visual, Microsoft is the best performer, okay? For the period under consideration from January 1, 2016 until December 30, 2022, Microsoft exhibited the highest average returns at 0.08%, followed by Amazon at 0.05, and then I think McDonald's, and then JP Morgan, Google first. Okay, and the lowest performer was Intel because it exhibited negative average returns. Okay, as far as the variance is concerned, we can see here that 0.006. Okay, McDonald's seemed to be the, I think it's McDonald's, the least volatile. Okay, either looking at it from the variance or standard deviation perspective, McDonald's was the least volatile, least quote unquote risky, because it has the lowest standard deviation. 1.3% lang, no? 1.3%. So, based on returns, it was Microsoft that was the highest performer. Based on the least risk, it was McDonald's. So that's why we have the Sharpe ratio in order to compute for the risk-adjusted return. So the Sharpe ratio is a risk-adjusted return because you get the proportion of the risk per unit amount of returns. You compute for the returns per unit amount of risk. So in this case, it's Microsoft. That's the best performer. For every 1 unit of risk, you're getting a return of 0.04 or approximately 0.05. Okay, the next performer is McDonald's at 3%, while Microsoft is at 4%, 4.7%. Okay, but that's looking at it from a stock perspective, okay, individual stocks. So in terms of risk, the highest risk is, who's the highest risk? 0.02. Did we discuss that? 0.0. Okay, the highest risk is 119, 117. So I think it's Meta, okay? It exhibited the highest risk, okay? So in terms of the highest return, it's Microsoft. In terms of the lowest risk, least risky, it's McDonald's. In terms of risk-adjusted returns, or AKA Sharpe ratio, then it's Microsoft. But it's looking at it from an individual stock perspective. And this is where the concept of diversification comes in. Because based on so many financial research, we are told that the way to go about an investment is to invest in a portfolio or diversify your assets so that you're spreading your risk. Okay, so before let's compute first for the excess returns. So the excess returns is simply equal to the returns of Microsoft. Okay, and then we net it minus the average return there. And then I'm going to, since we're going to copy the formula, we will just fix the row 6, so that it will not move away from row 6. So we subtract all of the returns here from the average returns. Okay, so I just copy this to the left and then copy this down. And then I color this for easy reference. Okay. Right. Again, let me stop and wait for you to follow along.
Hi, sir. Can I see the formula again
For
the yellow boxes?
the yellow box. Okay, you're just getting the difference between your returns and the average returns.
Okay, all right. Thanks, sir.
Then we fix this, we fix the row so that it will not move out of this row. Because we're going to subtract all the returns from the average returns.
Okay, sir. Thank you, sir.
Okay, so let's call this, let's give this a name. This one. Okay, by the way, are you done, class? Were you able to follow along? Okay, thank you, Luis. How about the others, class? Okay, good. Right, that's good. Okay, so we will be using some of these metrics, some of these measurements, okay, as we go along. So let's give these names. Let me just make this black again. Okay, for example, this one, let's give this a name. Let's call this, maybe let's just call it stock rep. Okay, stock returns. Enter. So this whole array here is now called your stock rep. Let's call this, let's just call this n, okay? Simply n, the count. And enter. All right, let me check. So this is n. And then also this one, let's call this, we need this later. Let's call it standard deviation, ST dev. I called it STD dev, standard deviation. Enter. All right. And also this one, we will be needing this. Let's call this, maybe let's call just excess ret, no? I'll call it excess ret, excess returns, because we're subtracting the returns from the average returns. Okay, so let me highlight this, highlight everything here, all these values, and then let's give it a name. I'll just call it X ret, excess returns. Enter. All right, and then let me check Control F3. Okay, so what are the names that we have used? End date, start date, and is your 1761, standard deviation, stock ret, and then your excess returns. Okay, so you should have these names in your name manager. Control F3. You should have this. Okay, let me pause for a while and wait for you to make sure that you have these names. When you're done, class, kindly chat, please. Okay, good. Thank you. Thank you, Kim. Thank you, Luis. Okay, let's wait for the others. Kindly make sure Kindly chat, please, so that I know when to continue. Okay, good. I hope everybody's done. Okay. All right. So let me close this. Okay. Now, okay, let me draw. Now, in this, use this. What we are interested in here is to compute for the return of our portfolio. We already know how to compute for the return of our assets, right? R sub I, which is just equal to the log of, let me just write here, log is equal to the log or ln in Excel, ln of the price at time t over the price at time t minus 1. Okay, we were able to get the individual returns per daily period. And then we got the average. This is the average. So this is the average log returns for the whole period from January 1, 2016 up to December 30, 2022. Okay, we're now interested in getting the return of the portfolio. And the formula to get the return of the portfolio is sum up all. Okay, so this is the formula. So you have your individual returns of your assets, multiply that by the weight of your asset. Okay, you have here how many? 3, 4. You have here eight stocks, right? So when you create a portfolio, you have, of course, you have a certain amount. You have a fund for that. And then you distribute your funds across your assets. Okay, so the first type of portfolio that we're going to look at is an equally weighted portfolio. So which means that we're going to divide whatever amount we have equally to these stocks. So that means that each stock will have a weight of, that's 1 over 8, right? That's 12.5. So that's equal to 1 over 8. Yeah, that's 12.5% each. So each of this stock will have 12.5%. So actually, we can now compute for the equally weighted portfolio because you now have the individual weights and then you have also the average returns. So you just compute for this, you just multiply that. You can actually get the sum product of your weights, okay, comma, and then your average returns, that one, which is your stock returns, right? Control Enter. All right, so for this portfolio, the average return was, let me increase this, 0.03. This is average returns. Okay, that's why it's very small. Okay, to convert it into annual, you multiply it by 252. Okay, but let's not do that now. So the average return of the portfolio is around 3.038%. Okay, so Microsoft individually has a higher return than the portfolio. Okay, Meta has a lower return. So which ones are lower? Meta and then Intel. So only two assets performed worse than the portfolio itself. Okay. Now the next one that we want to learn how to compute is the risk of the portfolio. Okay, so that's a more challenging task to do. Okay, so let me once again draw. How do we now compute for the risk of the portfolio? So the risk of the portfolio is identified either as the variance or the standard deviation of the portfolio. Okay, so either you compute for the variance and then get the square root to get the portfolio risk, which is the standard deviation, or you can also have a formula directly computing for the standard deviation. And the formula here is quite involved. No? The formula here is, let me write the formula. It's actually quite a difficult formula. It's double summation of W sub I, W sub J, and you have covariance Ij. Okay, let me explain this. I ranging from 1, J ranging from 1 up to N. N is the number of stocks that you have in your portfolio. Okay, if we have a two asset portfolio, this is very easy because the return, okay, may I write here? Okay. So if you have a two asset portfolio, two assets, the return of the asset of the portfolio will be very easy. R sub P will be equal to the weight of asset 1 times the return of asset 1 plus the weight of asset 2 times the return of asset 2. Okay, so that will be the formula. So quite an easy way to compute for the return. Now the problem lies with the computation of your variance, your risk. Okay, so let's compute for the risk of this two asset portfolio. And it gets more difficult if you have a 3 asset portfolio, a 5 asset portfolio. Okay, that becomes more difficult to compute. Good thing we have matrix algebra, which I'm going to explain not today because we won't be able to reach that, but next meeting. All right, so this is the formula, right? Your I is your first asset is equal to 1 up to 2, and your J is your second asset equal to 1 up to 2. So this is the formula. This is 2, by the way. W sub I, W sub J, covariance of Ij. Okay, let's explode this formula, class. All right. So how do you compute for the variance of the portfolio? Because once you get the variance, you just get the square root of that. Then you get the risk in terms of standard deviation. And oftentimes risk is measured in terms of standard deviation rather than variance. Okay, so we just have to perform this. Okay, so this is pairing from 1, 1, and then 2 up to 2, 2. So what we do is to pair. So first, let's do 1 with 1, and then we will do 1 with 2, and then 2 with 1, and then 2 with 2, because those are the possible pairs that you can do. So the first pair is W1, right? 1 with 1. So your I is 1, your J is also 1. So what's W1, W1? Class, what's W1 times W1? That should be, class, what's W1 times W1?
W1 squared.
Yeah, of course, W1 squared, okay? W1 squared, all right? And then for this one, it's the covariance of 1 with 1. What is the covariance of 1 with 1? So if I write that, covariance of 1 with 1. What is the covariance of an asset with itself, class? That is your, anyone? So this one, covariance with 1 with itself, Okay. Do you remember the formula for covariance? The formula for covariance is the cross product summation of your asset X minus the average of the asset, and then you cross multiply it with your asset Y minus the average of asset Y. And then this is n minus 1 if it's sample, or n if it's population. So take a look at this class. X minus X bar, Y minus Y bar. This is your asset 1, this is your asset 2. So that's what covariance is all about. But since asset 1 and asset 2 are the same, because you're getting the covariance of 1 with asset 1, so this will be the same, right? So that's X minus X bar times X minus X bar also. So that will be X minus X bar squared over n minus 1, summation of that. That now becomes the variance of 1. So it's the same as the variance of 1, but you write only 1 here. 1. Do not write 1, 1. Okay, because 1, 1 here will refer to covariance. Or you can write covariance of 1, 1, but no squared here. So this one is the same as this one. Okay, so we can write that the covariance of 1 with itself is the variance of 1. So only one number here, and then 2. So this is the variance of 1. Okay, am I clear, class? Could you kindly chat, please, if my explanation is clear? Any questions? Any clarifications? What we're doing now is we're trying to explode. We're trying to perform this operation and to get the risk, the variance of a 2-asset portfolio. Okay. All right. Any questions, class? Malabo ba? Come on, class. Give me feedback kasi pwede ko namang ulitin yung explanation. But you have to tell me, class, kung maliwanag or ano. Okay? All right? Sige. Okay, I hope the others are able to follow. But suffice it to say, class, that this is the formula to compute for the variance of a portfolio. It's double summation. And then you do pairwise. Okay, so there are only 2 assets. So, ang pairwise natin, 1 and 1, and then 1 with 2. So, isa-isa sila, no? So, this will now become W1 and 2. Right? And then this one becomes, this is now your covariance with 1, 2. Yan. Okay? So, that will be the second term. What will be the third term? So, we're done with 1, 1, 1, 2. Now, the next one is 2, 1, 2, 2. Diba? Apat lang naman ang combination yan eh. Kasi double summation lang yan. 1 with 1, 1 with 2, 2 with 1, 2 with 2. Ganun lang siya kasimple, class. It's not a rocket science. No? So let's now perform this 2 with 1. So that's W2, W1, and covariance to 1. Okay. Now, based on the formula, covariance to 1 is the same as covariance 1, 2. Kasi commutative naman to eh. Diba? It doesn't matter kung sino mauna dyan. Asset 1 or asset 2 or asset 2 or asset 1. Kasi you're multiplying. And then you're getting the summation. And then dividing by n or n minus 1. So these two, class, these two are the same. Okay, so we can write this as 2 W1, W2. Then, sorry about that. Covariance 1, 2. Right? So that will now be your second term. And your last term will be, we're done with W1, 1, 1, 1, 2, 2, 1, and the last one will be 2, 2. So that now becomes W2 times W2. So that's W2 squared. And then sigma 2, 2, that is the variance of your asset 2. There. All right, so the risk, okay, the standard deviation. Okay, so let me write down the risk of the portfolio. The risk of the portfolio now is equal to, I'm now putting here the square root of W1 squared sigma 1 squared, that's the variance of 1, plus W2 squared variance of 2, plus 2 W1 W2 covariance 1 2. There. Okay, this is now our portfolio risk. Okay, I'm putting the square root because I'm measuring it by the standard deviation. Okay, this one is for your variance, this whole equation. All right, so if it becomes a 3-asset portfolio, then it becomes more difficult because the pairing will now be 1 with 1, 1 with 2, 1 with 3. Okay, and then 2 with 1, 2 with 2, 2 with 3, and then 3 with 1, 3 with 2, and 3 with 3. So you will have to perform all of those. Of course, if it's now a 10-asset portfolio, okay, that will mean so many terms already. Now, the good thing is that we don't have to use this and manually do this formula. Okay, because there's a way in order to compute for the portfolio risk. Okay, so before we do that, let me just erase this first. Okay, now we have all right. Okay, so okay, I don't think we'll be able kasi mahabang ano to, no? Okay. What we will be needing is what we call the variance covariance matrix. And the variance covariance matrix, okay, there's a matrix formula for that. The variance covariance matrix has this form. Okay, let me write the form, class. Okay, let me insert symbols, and then let me call it let me use the capital. Ano, ito na lang. Insert. All right, IJ. It's the variance called variance. And IJ is equal to, okay, your X transpose is your X ret transpose, and then times X ret, and then let me explain this, divided by n minus 1. Okay, we will perform this next meeting. Just want to show you the formula. Okay, because this is quite long. So let me just fix the formula. Control 1. And let me put the subscript here. And then this one, X ret is, it's a transpose. Control 1. Let me put here it as a superscript. Okay. So this is the formula, class. We can compute for the variance covariance matrix, which we'll be needing for our to compute for the portfolio risk because this is 8 assets class. We cannot afford to use this formula, no? and compute for the individual for W1 squared, W2 squared, up to W8 squared, and then get the cross product of each of the assets. That will take us a long time. There's a formula to compute for how many terms that's needed. Okay. For 3 assets, it's 8 minus 1. Okay. All right. So next meeting, class, we're going to, let me just put it here and copy this also, Control C. Okay. All right. What are we going to do next meeting? We're going to compute for the variance. It's called the variance covariance. Okay, why is it called variance covariance? If you take a look at this matrix, let me put here some borders. Okay. When we pair our asset with this asset, so this one, class, this will be the covariance of Microsoft with Microsoft. But isn't it that the covariance of Microsoft with Microsoft is the variance of Microsoft? So all the diagonals here, class, when you pair the asset with itself, these are now your variances, okay? Because you're looking at the variability of the asset with itself. So this is, for example, Meta with Meta. This is Google with Google. So the diagonals here are your variance. The rest are your covariance. So if you take a look at this one, so that's the covariance of Microsoft with Meta. This one is the covariance of Microsoft with Google. Okay? Any questions, class? So let me just show you very quickly. Okay, if we're going to compute for this individually, class, this will take long. No? But with matrix algebra, let me just show you, class. It's so amazing that with matrix algebra, you can easily compute for this. And how do you do this? We have our XRET, right? We have our XRET array. This is our XRET, right, class? This one. XRET is this one, the excess returns. So that's our XRET. So we're going to use that. This T is transpose. Okay, but I'll explain this more in greater detail next meeting. So let me just show you how this is done in Excel. So you just highlight everything, okay? And then we're going to multiply the transpose of your XRET. Transpose means you interchange. The row becomes the column and the column becomes the row. So what we're doing here is equal to, okay? And then I'm going to multiply XRET transpose with XRET. So I'm going to use the function mmult. This is matrix multiplication. Mmult. So what am I multiplying? The transpose of XRET. Okay? There. So this is the transpose of XRET multiplied by matrix multiplied with XRET. There. Okay? So transpose of XRET with XRET, that's matrix multiplication. Okay, and then we divide it by n minus 1. We have our n, right? N is the count minus 1. Close. Okay, and then what you do here is, because it's a matrix, you press Control Shift Enter. Control Shift Enter at the same time. There. Okay, so this is now your variance covariance. So to quickly check, class, quickly check, what is the variance of Microsoft? This one, 0.00315. It's 0.00315. What is the variance of Meta? 0.00618. Isn't this 0.00618? This is the variance class. And if you check the variances, okay, Intel, what's the variance of Intel? 0.000459. 0.00459. Okay, we got it, class. So this is the way to compute for your variance covariance, which we will be needing in order to compute for the risk of the portfolio. Okay, because why do we need that? Because of this formula, class. You need the variance, you need the covariance. That's why we have this variance covariance matrix. Okay, so we'll stop there, class. Okay, this is a very important formula in finance, very important formula in investments, in portfolio management. So this one, X ret, this one, the excess returns transpose times X ret over N minus 1. And this is not an ordinary algebra multiplication. This is what we call matrix multiplication. Okay, so let's stop there, class. I know this is quite a mouthful. Okay, so we will look at this again next time. And please review the video, take a look at this, and follow by when we have our session next on Friday, class, make sure that you have this. Okay, make sure you have this. All right. So thank you so much, class. That ends our discussion for today.